hear you. Yeah.
Super. So back over to you, Anton.
Yes. Why don't you give us a brief background about you as well as Glastonbury Thorn?
Okay. All right. Yes. So, yes, I'm Jim Griffin with Glastonbury Thorn, and Glastonbury Thorn offers concierge services to investors who are interested in investing in notes. That is to say, mortgages and so. And that is for investors who would like to hand pick. I would like to have this particular note or that particular note in my portfolio. So that's what we help with.
Okay, very good. Now, our typical listeners, they are commercial real estate investors, whether they are investing in multifamily or other type of commercial real estate, as direct investors, or then also passive investors, very often in syndications. So they may wonder, why do we talk about note investing, right? What does that have anything to do that would add value to me as a multifamily or a commercial real estate investor? Now, I think what a lot of people do not fully understand is that monitoring and knowing about the underlying debt and the underlying debt portfolio and how they perform and how they evolve is actually a very good uh, signal. We can call it the canary in the gold mine or any other term we want to use. And we certainly have seen that in 2007, 2008, when anyone who was involved on the debt side already saw clear signals there, whereas the investors who were just buying properties and investing in properties, they were really caught off guard, right? So that's why I think talking to an individual like Jim is really important to get a feel for where the market has been and for how it's evolving, and also what do you think it's going to look like down the road, and what potentially your strategies could be. Jim, can you give us a little bit of a picture of how obviously we went through COVID-19 since early 2020. Now it appears that we are now getting back to hopefully as normal as possible, as quickly as possible. Uh, but how has that been working with you on the note business side?
Okay, so let's break that down into two subtopics that, in some sense, you've talked about. But first, just briefly, sort of from a tactical standpoint, when you set up that question, you were talking about the fact that many of your listeners invest, for example, in multifamily and commercial, and how would about notes being relevant for them, and so forth and so on. So, just very quickly, it's interesting to think about, as you invest in notes, you can create basically a virtual multifamily, can't you? So, whereas that multifamily is all, by definition, all concentrated perhaps in one or two city blocks. So it has all that geographic risk, or, if there's a fire, it's going to affect probably the whole thing. If there's a change in crime rates, it's going to affect the whole thing. If there's anything in that specific local environment that is causing more vacancy, it's going to affect the whole thing. Whereas buying a portfolio, a virtual multifamily of maybe 20 notes or 40 notes, they can be spread across multiple geographies. And you can imagine already, without my saying anything more, what the advantage would be of that. We could talk more about that, but let's get now to the question that you raised, is which I think is very perceptive, that in the past, those who invested in notes got uh, sort of preliminary insights about what was coming. And indeed, we do have now, at this moment, sort of mixed signals. So what everybody is talking about is the good stuff, right? That's the cocktail party talk. The market is on fire. Boy, when you put something on the marketplace, you get multiple offers and they're all over asking price. It's amazing. And this is great. So indeed, it's true. I mean, when we talk about year on year median price for existing homes, back in June, when this kind of started, and you ask yourself, why were prices starting to go up in June because of COVID? Doesn't make sense. Of course, we know it's because all this money started to be injected into the economy. But anyway, though that median price notched up pretty significantly in June by about 3.2% year on year, June 2020 versus June 2019. By July, it was up 9%. By October, it was up 15.5%. And the most recent month for which I have data, which is February, it hit a new benchmark of 15.5%, 15.8%. So in other words, in February of 2021, the average change in median existing homes was 15.8% greater than the year before. So that's amazing, right? And you can see this whole shift in the market up the brackets. What were the traditional brackets? 71% of the market was 100,000 to 500,000, and you can subdivide that and so forth. But all those brackets are shifting. So the brackets that were like 100 to 250,000, that's down 10.7%. And the higher the bracket is, the more it's increasing. So all that's good, right? And that's all the cocktail party stuff. So now, behind that, we take a look at, what I see on the notes side. We can see that a lot of smart money doesn't apparently share this optimistic view. And one of the ways that we can see that is taking a look at the Mortgage Bankers Association Mortgage Availability Index. So this is an index that is tracked year on year. And we can see that right now it's about, the index is at about a 125.4. It's trending up a little bit, but it is down about 35% versus December of 2019. In other words, for every 100 people who could have gotten a conventional mortgage in December of 2019, 35 of those same people with the same credit scores and the same profiles cannot get a mortgage today. That is very significant. And at the same time, those people who are getting loans, do you want to guess what the average down payment is today? So we're talking about all these offers over asking price, right? Who's paying that extra over asking price? Well,
it all comes with equity, right?
Well, yeah. I mean, it comes with cash.
Yeah.
So somebody doesn't trust that optimistic price. So the average down payment right now, according to Ellie Mae, is 19% on residential. So you add it together and you can see that there's a lot of smart money on the sidelines that doesn't share this wildly optimistic view that we're hearing at cocktails.
Mm-hmm. Yeah. Very interesting. I think what also probably plays into it, and you can tell me if I'm wrong, is the smart money obviously wants to see that value cushion on one hand, but at the same time they also see that affordability issue that comes into play with a lot of borrowers, right? So the ones that can afford to put in more cash, they can bring the debt down so that it's still meeting the debt to income ratio. But it's essentially limited to the ones that have the cash. All the others are pushed out of the marketplace, right?
Yes, yes. These factors are all coming together, and another signal that we can see is flipping profits. Many of us, are kind of like a little bit on the sidelines right now with flipping, but if you do look at the flipping profits, the overall gross profits are floating, are trending up, but the ROI percent has never been so low as it was maybe 2011 or 12 was the last time we saw the percent ROI on flipping down this slow. And
Yeah,
again, the reason is obvious, that pressure to buy those properties, trying to find those good buys, is becoming more difficult.
sure, absolutely, right. You better hope that these values go up. Otherwise, you're left with your hard money loan that still has the accruing interest, right? And it doesn't take much. We have a couple of clients who on the multifamily side that are also active on the flipping side. And there was a brief period, particularly in California, right, in the LA and Bay Area, in 2019, where there was a little bit of a cool down, and a lot of them got caught off guard just for a few months, and it can, whatever looked like a great profit can turn into a disaster very quickly there.
Yes, it's not funny.
Yeah,
Yeah.
yeah. So, so what you are talking about, right, when it comes to individuals or lenders asking for more cash down payments, and then also that aspect of affordability and all that, it's only short term at least that has created a major boom also for multifamily, right? Whoever now cannot afford to buy a single family home, either because it's not available, because a lot of the prospective sellers are not even selling the properties, they hope that they can even sell it for more. But apart from the supply constraint there is only affordability issue. And that definitely has helped now also to fill some of the multifamily properties that have been struggling. And as we know, right, over the last 12 months of all the commercial real estate, multifamily has been the darling. And a lot of owners have been able to fill these properties very quickly because a lot of the new tenants were all prospective single family buyers and they cannot afford it anymore. But I think the message there still is, right? Whereas on the single family side, the lenders obviously are pulling back, right? They want to see more equity in there. They are not changing their qualifications for the buyers with the debt to income ratio. Whereas on the multifamily side, we certainly have seen a lot of property owners adjusting their criteria for their tenants to qualify downwards so that they actually can pay the rents or the higher rents, right? So the reality is, yes, all these new tenants, they come in, they need a place. Very often you can raise rents because they need a place to live. But on the flip side, very often these new tenants, they cannot really afford all these rents. So what do property owners do? They are making concessions on the tenant qualifications, right? So that will be the interesting thing to watch going forward. How many of all these tenants that they are now able to get on board are actually long-term paying tenants, and how many of those will turn into more problematic tenants with delinquency issues.
Yeah, that's certainly a question. I mean, I can think of several properties that I've got signed agreements to purchase in my market that I can't close on because the seller can't get the tenant out of the property, which is a condition for closing, and the tenant is not paying, and they can't evict.
Mm.
Now, that is a big hardship. So on whatever scale, there's not that many investors that can last that long, not having rental income, having to still pay their mortgage, and not being able to evict. That's a tough one.
Yeah, it's an excellent point, right? I think what is also almost kind of unfair, right, in that whole picture, is that obviously it's always everyone sees all these large multifamily properties, and everyone feels, including many people in government, oh, these are all these extremely wealthy property owners that can afford to keep these tenants in their properties without paying. And obviously, if you're a REIT and if you're a large hedge fund or a private equity fund, it's easier for you to afford. It's still not fair, but at least you have the ability to fund some of the shortage for a longer period of time. But what no one really recognizes is that the majority of all these rental properties, from single family to small multifamily, they're all individual owners, and they do not have that massive cash cushion to just carry all these tenants that by law are now allowed to continue to live there without having to pay, right? So that will definitely be very interesting to watch how that all turns out. I think there will be some opportunities. Obviously, there will be pain, but I personally see, particularly in the smaller rental segment, that there will be much more pain points, and as a result, also opportunities for buyers that are looking at that market. Would you agree with that?
Completely agree with that. It's interesting. I think, I don't know if you know, but I spent quite a number of years living in Asia, and the kanji character for crisis in China is actually a compound. Like we have compound words like firefly is composed of the word fire and the word fly, and yet a firefly is neither a fire nor a fly. So the kanji character for crisis is a combination of two words, danger and opportunity. And isn't it interesting? Because we're in the middle of a crisis, and when you're talking about a economic crisis, there is always embedded in there some kind of opportunity if one is ready. And I do believe that the opportunity that you're describing is a very big one. Those tired landlords who have had it and they just want out.
Yeah, that they want out or have to get out, right?
Or have to get out.
Yeah. Yeah. So of the loans that the notes that you have been buying for yourself as well as for your investors, where would you say the performance has been over the last, let's say, pre-COVID, during COVID, and what do you see is going to happen now this year? And obviously, you don't have a crystal ball into next year.
Mm-hmm. Well, let's start by saying that, broadly speaking, we can classify notes at any given time into two broad groups: performing and non-performing. And if we're prudent about how we select notes, then in the performing category, we have every good expectation to continue to collect those payments. And and of course, we know that we have exit strategies if those payments do not come. That's not our goal. And within the performing category, we're going to have a range of yields. And of course, if you pick a note that is like perfect in every way, the house is beautiful, the neighborhood is perfect, there's no crime, the economy in that community is going up, The vacancy rates are down. The investment to value is perfect. The payment history is ideal. Blah, 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 blah. Every criteria you can think of course, that note, its yield is going to be at the low end of the range. And as you find notes out there that have got these amazingly high yields, just go look and you'll find the reason why they have amazingly high yields. And so basically, if you just hit the ball in the middle of the fairway and say the 6, 7, 8, 9% yields, you can find good solid notes that are going to pay and, that are secured by nice assets and they're checking the boxes. But now, your question, what do we see coming? Well, one thing that I think we can say fairly sure is brace ourselves for a pretty big tranche of non-performing notes. And those non-performing notes, for those who have an appetite for that, are a different thing. So there, the play may not be that you're expecting to get the payments. I mean, after all, the note is a percentage of the value of the property, and then you're probably buying the non-performing note at a very deep discount to the unpaid principal balance. So it's a discount on a discount. Just try to get those kinds of discounts doing direct mail advertising, saying, I want to buy your house. So that's another thing.
Mm-hmm. Yeah. Obviously, it takes an effort to find those, right? Direct mail, and whether it's for wholesaling, even for multifamily, technically it's possible, but it takes a lot of effort and time and money, right? Mm-hmm. And you may be able to find some great deals there. But I think what's only if someone uses a service like you do the footwork for that, so someone can focus on their core investments rather than now attempting to find that needle in the haystack that is now the right loan, right? Mm-hmm. So why don't you give us a little bit of a picture what you're doing and what type of loans you're typically buying, and how let's say our listeners, obviously they are heavily involved in multifamily and commercial real estate directly, but as a diversification tool, if someone has an interest to invest in a note, maybe you can give a little bit of a picture there, what would be what they could expect.
Yeah, diversification is really a constant theme of people that I talk to that have a lot of experience with syndication and doing things at certain scale. But they are always fascinated by notes, and they always say to me, I've always wanted to kind of get and learn a little bit more about it and buy a couple so that I kind of understand what it's like. And so the first thing that I can say is that I do have a pretty extensive ebook that would be available if somebody were to just send me a message at info@gthorn.com. G, of course, standing for Glastonbury, and then Thorn, Thorn, gthorn.com. I can send you that ebook or a link to download that ebook, which has like 31 criteria for selecting notes, and then it follows with the step by step. What do you do in order to buy a note? And after reading that, you pretty much see, okay, there's a lot of factors to consider, and it's a fair amount of work, to kind of filter and say, not this one, but that one. So I do that. And, it's just like buying a piece of property, investment property. There's a realtor involved, and nobody pays the realtor. No buyer pays the realtor. People always ask me, so what do you charge? There's no charge. I mean, there's a price, and don't worry, I won't starve. But it's, all you see is the cost of a note and what's the yield, and you decide if you want it or not. It's that simple.
Sure. Mm-hmm. Yeah, that's very good. So do you focus on certain states? Obviously, you're based in Tucson, right, in Arizona. Do you focus on? I assume Arizona is a market that you are focusing on, but do you do it across the country, or do you have some markets that you like or dislike?
That is a great question. So the initial answer is I would buy a note in any state. Okay. Now there are certain states that I love less than others. New York would be a state that I love less. New Jersey would be a state that I love less because of the environment there, the political and legal environment there right now. But I would buy a great note in any state. But what I've found is that when I'm done filtering through on all my criteria and trying to figure out, okay, what's the best yield, what's the best value, and then I go look at this state, in general, my notes turn out to be mostly in the Midwest and Southern states. That's where I'm finding the best value. It's not because I'm filtering for that. It just turns out that way.
Yeah.
Very
Okay.
rare that I find a great note on the Pacific coast. So it just turns out that way.
Okay. So what do you think is the reason why the Pacific coast is generally not that great? Because the everything is already so highly valued, and the margins that you have, the safety margins are lower, or what is the reason for that?
Yeah. So, I mean, there are a number of criteria that, one can look at. Some are more important than others. So, I'm very favorable to as low an investment to value as I can get. And so that's one of the things that I look at strongly. And so, those nice investment to values tend to be uh, more in the states that I just mentioned, in the Midwest and in the South.
Yeah.
There's less volatility. I don't like volatility when I'm investing. All those kinds of factors. You
Yeah.
put it all together.
Yeah. Okay. Very good. Uh, Great. I think, Jim, you provided a lot of value here. Obviously, it's a little bit of a different spin on what we are typically talking about. But as we discussed, whatever is happening on the note investment side, including single family, right? It has a direct impact on the multifamily side, and it's only gives some signals of how lenders look at it on the single family side, and maybe some multifamily investors should also take note of how they view the state of the market right now, when they invest in multifamily, refinance multifamily, or also just make decisions when it comes to tenant qualifications. Should you really be that aggressive, or should you take kind of a lesson out of the book from lenders and say, well, maybe we just need to stick to our past criteria rather than losing them just to fill the property.
Mhm.
Yeah,
Yeah.
yeah.
Wise
So
words.
yeah. So thanks again, Jim. Was great having you on. So you mentioned your email. So maybe you just can to wrap it up, just to provide again your contact details.
Sure. Yes. My email, you can reach me at info at g gthorn.com. So, um, yeah, from there I can provide you with links to
Yeah.
multiple other things.
All right. Very good. Thanks again,
Alrighty.
Jim, for joining us today.
Thank you, Anton. Bye-bye.